with the show. So the first thing is, did you know that the U.S. population growth is at its highest right now since 2001? Over 20 years. Would you have expected that? Not me. Now, this is quite significant if you look at this graph because the numbers are actually a lot higher than you would have assumed. Now, those people have to live somewhere, so they're either going to rent or they're going to buy houses, meaning that's going to put upward strain on housing, both renting and owning. Quote, according to the U.S. Census Bureau's latest estimate, the United States resident population grew by an astounding 3,304,757 to a total population of north of 340 million. The population grew at a rate of 0.98%, the highest rate since 0.99% in 2001. Again, as I say, over 20 years ago. This also marks the third straight increase in the growth rate of the U.S. population. Now, again, if we're looking at pricing going down and finding more affordability, this is going to be one against us. But that's not the case in this really topsy-turvy 2026 market that we have right now, that everybody is trying to figure out which direction it's going to go. Now, the second point is pretty interesting, and it's something that we talk about quite often. People who are looking for affordability, they're going to the Midwest. This is according to the Wall Street Journal. We are going against the flow of the Joes of the grapes of wrath who went from the Midwest during the Dust Bowl and came out to the West Coast. Well, both coasts are moving towards the Midwest right now. The most affordable cities to buy a house right now, number one is Toledo, Ohio, in the Midwest. Number two is Syracuse, New York. Not exactly Manhattan, though, is it? Number 3 is Scranton, Pennsylvania. Number 4 is Rochester, New York. 5 is Hartford, Connecticut. I mean, who'd want to live there? 6 is Baltimore. Number 7 is New Haven, Milford, Connecticut. Number 8 is Salem, North Carolina. Number 9 is Albany, New York. And number 10 is Columbia, South Carolina. I've said this before. If you have clients in some of these high-cost areas, I would call a real estate agent in one of these affordable, upward trending cities and say, listen, get me some great properties that would work for rentals. Not surprising, but did you know that producing loan officers grew their ranks in 2025? This is according to the great site Redder. Quote, the mortgage industry saw its first annual increase in producing loan officers since the COVID pandemic, with 221,161 active loan officers in 2025. Broker headcount grew, while those employed by IBMs, they declined. Moral to the story here is more loan officers are looking to the broker channel. That's why you should call me, because brokers are going to get you better pricing. And pricing right now, particularly in refinance markets, it does matter. Mortgage demand dropped by nearly 10% to end the year 2025 despite lower mortgage interest rates. Quote, mortgage rates decreased to 6.25% from 6.32%, the lowest level since September 2024. But lower rates did not mean a boost to mortgage demand. Mortgage application volume dropped 9.7% over the 2-week holiday period ending 2025. That's a pretty big drop-off. Did you know that homeowners with mortgage rates above 6% has surpassed those with 3% for the very first time? Recent data shows that more homeowners have mortgage rates above 6% than below 3%, challenging the mortgage rate lockdown theory that people aren't going to move. And I've always said, yes, they are. And technology is helping the game. Today's bank statement programs use sophisticated algorithms to analyze cash flow patterns instantly. Instead of manually reviewing 24 months of bank statements, advanced systems can identify business revenue separated from transfers and one-time deposits and calculate qualified income in hours, not weeks. And as I told you a moment ago, per Scotsman Guide citing S&P Global predictions, non-QM will represent nearly 30% of non-agency mortgage-backed securities by the end of 2025. Yikes, that's already happened. A signal of strong and growing demand from institutional investors and the secondary market. Did you know the Federal Reserve just pumped $16 billion into the U.S. banking system with overnight repos? It's the second largest injection of liquidity since COVID. So you're probably asking yourself, what in the hell are overnight repos? A bank needs cash for like a day. So they sell high quality securities, collateral to another party, like the Federal Reserve, for that cash, and then they buy it back immediately the next day at a cost that is fractionally higher. The price difference is the interest that is paid, and what it does is it gives money to banks that need it for a very short period of time. And they're doing this at a pace they have not done before because banks need the money, because we are pulling more cash out, lowering our savings because we're paying more on interest and cost due to inflation, which is the reason why people are refinancing their houses and pulling cash out. Oftentimes it's not because they want to, but it's because they have to, and our overnight repos with the Federal Reserve proves that. Millennials, they have a hard road to home ownership. First of all, they entered adulthood pretty much weighed down by student debt, as I did, low salaries, and the aftermath of the Great Recession. They saw what their parents went through, and they said, I don't want any of that for me. Millennials have always been on the outside looking in when it comes to housing. Now, there was a 2026 report on millennials, a survey that was done of them to see exactly what they thought about housing. And frankly, I find this positively surprising. Did you know that 40% of all millennials right now say buying a home is what they desperately want to do in 2026? 97% of millennials say that they have at least one barrier to home ownership, with the top barriers being finance in nature, homes are too expensive, that's 46%, interest rates are too high, that's 40%, we're doing a bad job with that, and saving up for a down payment, that's 34%. Now, 96% of millennials have concerns about purchasing a home, which makes sense. Chief among them is finding an affordable home, cited by nearly 1 in 3 millennials, about 30%. The median U.S. cost right now in the United States is about $410,000, but 59% of millennials plan to spend less than $400,000 on their home, meaning they're going to be buying left of the Mason-Dixon line, if you know what I mean. 44% of millennials, including 50 home buyers, which represent about half of them anyways, would be willing to spend half or more of their monthly income on housing in order to afford a house. More than 3/4 of millennials, 78%, say the possibility of lower mortgage interest rates in 2026 would entice them to buy a house. But half, 51%, would only consider a mortgage if it came with an interest rate lower than the current level of 6%. And I call bullocks on that. You watch. You show them the right house, they're going to buy it regardless of interest rate. 34% of millennials say homeownership would be more affordable if they had better spending habits, but most would not reduce their spending on gym memberships at 77%, and that doesn't cost anything anyways. Subscription services at 71%, they want their Netflix. By the way, you know you could pirate that stuff, right? Or coffee, 67%. Make it at home, my friends. About 3 in 4 millennials, 72%, say home ownership is still part of the American dream, but 75% think that the average millennial cannot afford a house today, and I gotta tell you, they're right. 41% think that they're going to be the last generation that's going to be able to afford a house in their family, which I guess would probably make it that much more important. 1 in 4 millennials, 24%, have more in debt than they have in savings. Yikes, yikes, and yikes. But frankly, the number's lower than I thought it would have been otherwise. Only 28% of millennials can afford 20% down payments on the median home, but they don't need to have that. In fact, if you get them in on a USDA deal, you can even avoid that MI. Listen, the point is this, we can go on and on. Millennials are fantastic and a viable option for you. So make sure you put that arrow in your quiver and go after millennials. Let us know in the comments down below. This is really kind of a wacky thing, but the government has new data on inflation, and there's an assumption in there of zero housing inflation in their overall inflationary numbers. Now, this is the reason why we saw a huge drop in November. We did not have housing and inflation. How could you possibly do that? That makes no sense to me. Quote, the government's long-delayed November inflation report appeared at first glance to deliver welcome news. Consumer prices rose only 2.7% from a year earlier, while core inflation cooled to 2.6%, the lowest reading in years. But for many economists, the number immediately raises red flags, especially on housing, the single largest component on inflation, and it's not added in. Again, whenever you read numbers that we get from the government, we have to take these with a grain of salt. Now, if you think things aren't out of whack, I want you to watch this little video here. It's crazy. It's home prices versus salaries. So as you can see, they're pretty close. At one point, salaries actually outpace sales prices. But then look what happens. Now follow this through to the end. More Americans Americans are losing their homes as foreclosures jumped 20%. What's driving this? Well, I'll tell you what I think is driving this. I think it's inflation. People can't pay for anything. And out here in California, it's not just inflation, but it's the additional costs that we have on absolutely everything that we do. Because a fee is just a tax by another term. Quote, foreclosure filings shot up nearly 20% in October from a year ago, highlighting a growing pocket of distress in the housing market. Nearly 37,000 new properties in the United States had a foreclosure filing in October. This is according to a new report by Atten. Now, here's the thing. The United States job cuts surged by 183% in October to a record 153,000. Is this the end of America's no hire, no fire landscape? Well, I think it might be. Quote, experts say the United States labor market is a no hire, no fire landscape, but our recent staff cuts at major corporations signing a shift. What are your thoughts on that? Or do you even believe that we have 183% higher job cuts? Quote, for most of 2024-2025, the U.S. jobs market felt oddly still with relatively few mass layoffs, but no big hiring booms either. Economists call this a no hire, no fire era, a rare moment when employers seem frozen in place during the pandemic churn. Again, guys, feel free to reach out to me. Here's my phone number. Anytime. So, listen, my friends, you guys make it a great hump day. With that said, you all make it a great day, and I can't wait to see you till tomorrow. And do me a favor, forward and share this. Keep the conversation going.